Hello everyone and welcome back to another video. Thank you so much for subscribing. I can't tell you how much I appreciate it. Thank you so much. It's incredible to see all the support that I've gotten in the last few videos I've uploaded. Thank you so much. Please do subscribe if you have not already. Now let's get right into it. So as you can see on my screen, I have 4 different watch lists open from my CNBC app, and I thought that this would be easiest to go over exactly what is in my portfolio. I'm 27. I will be 28 in February of 2022. So I am, getting closer to 30, but I've been investing in these different securities for some of them the last 6 years. So I started ramping up my investments when I was around 21. I started investing in 2013, so I've only been at this for 8 years, and so far I've learned a lot. I've been lucky. I have not lost a lot of money. I have not put in a lot of money either, but I have not lost a lot of money, thankfully. I'm very happy that has been a real thing of me not losing. And the only way I know that is when I look back at previous year's tax returns and I look at my gains and losses. It's not bad at all. It's not nothing bad to report back. Like I have losers, don't get me wrong, but I don't have high dollar losers. So it's not like I've, lost $5,000 or something like that. So anyway, let's get right into it. This is going to be the first account that we're going to look at. I do have a brokerage account, taxable brokerage account, where most of these are they're all growth. It's completely growth stocks. So I have Square, I have Microsoft, I have Apple, NVDA, Adobe, and Monster. Monster energy drinks. So clearly 5 out of these 6 is a tech heavy port. And basically my plan and my idea with this one is just to invest in the things that the index funds all invest in consistently every single week. So or even like hedge funds, pension plans, 401k plans, they all invest in these consistently. So there's constantly, as you can see, the lowest volume that I have is Monster Energy drink from this past Friday, which was 2.7 million trades happened for Monster Energy. And then the highest was 114 million for Apple. So that's a lot of volume. That's a lot of movement in these stocks. So that is what I'm trying to do, is I'm trying to use the winners of these index funds that constantly have high volume flowing in and out. I'm trying to use that to my advantage, and I kind of break out the individuals from the total. So not only do I invest in the indexes themselves, but I also, ETFs that mimic the indexes, but I also invest in the ones where this is, some of the key components. These different stocks are all huge parts of the indexes, and a lot of the money goes towards them based on the allocation in the index. And I'll just give you a little history lesson. Square itself, I have, it's at $255.79 as of September 17th, 2021. I have owned Square for 6 years since its IPO in 2015. I have held it for 6 years, and I bought it originally at $13.50 a share. I have not sold or bought another share of it since, and so as you can tell, I'm doing pretty well, going from $13.50 to $255. So that's my story on my brokerage account. Next, we will look at my brokerage account ETFs that I hold. So this is a very specific allocation, and this was planned this way. So 20% goes into each of these in my ETF portfolio. And again, you can see this is extremely tech heavy. So we have FTech, which is a Fidelity MSCI IT ETF, and I bought it at a very, very good cost basis, like a long time ago, like 2 or 3 years ago, and I have not bought or sold any shares since. Actually, I think I have bought some more. I've averaged up, but I have not sold any since owning, and so I have a really good cost basis on this specific ETF. The TDIV, this one is interesting. I love this one because this is all of the highest dividend tech stocks that are trading on the NASDAQ. You can buy them in this ETF and you can get a yield of like close to 2.5 or 3%, which is the aggregate of all of these like different NASDAQ tech stocks put together that pay a dividend. You reap the reward not only of them going up, but you also reap the reward of the yield. So this thing has gone up like crazy since I've bought it, and also it reinvests as part of like the dividend reinvestment, a really good payout that buys more shares. And again, it's all tech ETF, so it's got like the highest ones first. Obviously, it uses that, and then it pools the money to buy more of those shares. So it's kind of cool that I don't have to buy IBM separately. I can own IBM, which has a high dividend yield, as a tech stock in this index, and it gives me the reward by spreading that money that would normally come from just IBM and putting it towards things like I can't even think of it right now, but like I think like Microsoft and stuff like that. So it's really cool. Then I have the Dow Jones Industrial Average Dividend ETF, and again, this is a really cool one. It is pretty high yield. I think it's over 3%, and it has really helped a lot in the gains. So I really like that one. And then the newest one that I've bought is the iShares Evolved. It basically mimics the FTech one, FTEC, that I have too, and it's just a lower cost basis because it's newer. It was newly created, I think, in 2021. I could be wrong. Check me on that. And it has done pretty well. And then to anchor it, I have the classic Schwab 1000 Index ETF, which really does mimic the S&P 500 as far as returns. Yes, it does own 1,000 different stocks in its ETF, but it is very well diversified and spread out, literally double what the S&P 500 is. So it really does help as far as how much I can make off of it in slow and steady. I have a very good cost basis on this one too. And now if we go to the traditional IRA that I have, this is basically where I have had past 401ks rolled over into this traditional IRA, and it only holds two different securities in it. It holds, again, the Schwab 1000 Index ETF, and it holds Microsoft. I personally, outside of the money that I've spent on, outside of the money that I had from my 401ks, I have not put a single penny into my traditional IRA, and it has grown. I think you can go watch another video of mine, upwards of like 93%. Which is absolutely crazy. I have a gain of 93% in my account just by holding these two. And I found that this has worked for me. This is the most simple portfolio I've ever built of just two securities, and it has gained 93%, mostly because Microsoft is just a massive, massive gainer in all of the indexes. And like I said before, it has such high volume. Like, look at this, 34 million versus 122,000 for the overall index of Schwab, and yet it goes up like crazy or down like crazy because of like an S&P 500 would. And yet this is kind of crazy that, again, I can reap the benefits of having $34.6 million volume of shares traded in this specific one too. Will drive the price of this up and down on its own. So that's kind of crazy. And again, this is my most simple portfolio that has made me money since I think I started investing in these two back in 2018 when I started my new job. I rolled over my former employer's retirement into this traditional IRA, and so far I'm looking at it right now on my phone, and I have gained, yes, 93.02% on this account by not putting any additional money into it, just using the original cost basis. No additional averaging up or average down. So that's pretty cool. Now let's get into the big one. This is my Roth IRA, and I'll get into a video. Check out my next video or one of my next few videos that I'm going to be talking about buying income, how to buy income. You can pay to earn. So this is where I use that thinking of buying income. Not only is there a lot of growth stocks in this, these are all individual securities, by the way. I don't think I own a single ETF in here or index fund in my Roth IRA, but these are all individual securities, and for the most part, they are either paying me a dividend or they are high growth. So I have Albertsons. This one is my best one by far. I've gained over 100% on it, and it pays a dividend, and it's really nice. I have Google Class C shares. I have Amazon, that's growth. I have Citizens Bank, which is, again, that's the only bank that I own, I believe, outright, and it is a very good dividend. I have Facebook, that's high growth. I have Honest Company, that's a high growth company potential. I have the Realty Income Corp, just ticker symbol O. This one is a REIT and it pays monthly. So this is where another good reason to buy a REIT is it's completely tax-free in a Roth IRA, which is a great thing. Again, check out my other video. I have SOFI, which is another new stock that's completely high growth. Squarespace, another growth stock, completely high growth. Coca-Cola is a dividend-paying stock, which is, helps perpetuate this engine of buying income. I have Traeger, which is a very high growth stock, and I have Walmart, which is a great dividend play. So the reason why I hold a lot of the brand new companies that IPO that are like special, that I think are special in this account. So this is a way to not get bit by having huge tax losses or gains, is investing in my personal opinion, investing in IPOs in a Roth IRA is so simple because you can gain massive gains just by holding these types of securities in something like a not taxable IRA, something that can grow tax-free over its lifetime, and they're brand new companies. I am young, so it makes sense for me to do this. These brand new companies that I think are going to go somewhere or are special, or I have some type of inclination as to, I think that they're going to do really well, and I hold them in my Roth because it's a win-win. If they go up, then I will do very well, and I would have invested very early in them. So that's the whole point, is investing in their IPOs in this type of fund, in this type of account. So and that's also why I do like a Roth, a REIT in this Roth, is it pays income tax free, and I can use that income to buy other securities. That's at least how I do it. So I don't reinvest the dividends in the REIT. So anyway, this is my basically everything that I own. Believe me, I don't own a full share of Google. Like, the fun part about this, and this is a huge disclaimer, is all of these, if not most, are fractional shares. You can buy like a tenth of a share of Google if you want to, or Amazon, and only spend $200 for a $2,800 stock. Like, you don't have to go all in. I do not own multiple shares of a lot of these. They're mostly fractional. So anyway, hope that you guys enjoyed this video, and I'll see you soon.